Hello, my name is Paul Stevers, chair of this conference. And I don't know if you've had a chance to listen to the previous sessions, but the human security was, I think, very valuable on the impacts of climate change on human security, and very encouraging with the all the different climate solutions that are possible. And now I would say the most encouraging thing is what's happening in the world of finance. So we're going to be talking about financing climate action on a global scale. And the first person I want to introduce you is a very impressive guy with a company that has hundreds of billions of dollars in assets, that is working on a plan with many partners that I think can create a much improved global financial system. And person is Steve Waygood. He leads the Aviva Investors Global Responsible Investment Team, which is responsible for integrating environmental and social corporate governance, or ESG, issues across all asset classes and regions. About $500 billion under management. Steve, US dollars under management. Steve has recently been appointed to the European Commission High-Level Expert Group on Sustainable Finance and UK Finance Task Force. He's also a member of the Financial Stability Board Task Force on Climate-Related Financial Disclosure, that's called TCFD. Steve is a member of the Chartered Financial Analyst Institute with a degree in economics and PhD in sustainable finance. He is currently leading a major initiative called the Coalition for the International Platform for Climate Finance, and is here to talk about his progress and where he's going with that. Hello, Steve.
Thank you, Paul. That was a very kind and a little lengthy introduction. I'm sorry about that, but thank you very much indeed for being so kind. And Paul, for your leadership and for convening this conversation and for being part of the International Platform for Climate Finance. Having CSSAN alongside us has been fantastic. Just to add a little to what you said, I work for Aviva. Aviva was created in 1696. And so having been around for 325 years, I've worked for the last 15 of those with Aviva, and 25 in total on sustainable finance. We have, at last count, nearly 850 billion Canadian dollars. I lost the billion there. And it's been fascinating listening to these presentations, and of course the last event you hosted, Paul, that I was able to come to too. And since then, I've been thinking about the interaction between finance and climate risk and national security. And a few thoughts have struck me. I've been referring to some military planning doctrine, and forgive me, I know a novice should never do this, but I've read Sun Tzu's Art of War for many times. I know it's a cliche in military planning. And of course, a good military planner looks at cause and tries to deal with that rather than just simply mopping up the effect at the end of the day. And as Sun Tzu reminds us, we should know the enemy. Now, in this case, the enemy is not specifically climate change, it's the causes of climate change. And I think that diagnosis helps us understand how we stop it. And he also says, Sun Tzu is very clear, that the supreme art of war is to subdue the enemy without fighting. Now, how do we subdue the enemy when the enemy is the way we have financed economic growth, the way we have powered economic growth through fossil fuels since the Industrial Revolution, which was about 50 years after Aviva was created, back in 1696. Now, if it's fossil fuels and the burning of those and the emissions that are generated that are causal, we should also look at how much benefit they have provided. Arguably, a huge amount of poverty alleviation is directly attributable to fossil fuels. And we should be also grateful that the economic growth that has precipitated has lengthened life expectancies. But it's the cost of that we now need to consider. And it's interesting to consider that the cost of the level of dislocation of, for example, individuals, the implied temperature change in the London Stock Exchange is closer to 3.5 degrees than it is the Paris Agreement's 1.5. So we're heading towards a scenario where the markets, where capital markets are destroying, not delivering the Paris Agreement. And that, I think, is part of the causality here. We've created a market which is failing to optimize social well-being for the long term. Any market failure, as any economist in the crowd will know, market failures are, if the market left uncorrected leads to a suboptimal outcome for society, we can say we're in the presence of market failure. And climate change is arguably the world's biggest market failure. We need to therefore rethink how the market is structured. And I think that there are two elements to this consideration. The first is, how do you harness the profit motive? And the second, as Paul referred to in the introduction, is how do you harness the international financial architecture? Now, on the profit motive, it is worth just flagging that every fundamental analysis of every large institutional investor like ours will be based upon a discounted cash flow at some point. Now, a DCF discounts future generations. It ignores externalities, so costs that will hit society and the environment, but not the company. And it also assumes all things will continue to grow forever. Those are three of the founding assumptions of DCF that one can change, of course, but people tend not to. So that discounting of future generations means that the future cost of the consequences of 3.5 degrees, where 74% of the world's population won't be able to live where they do without air conditioning, that future cost isn't considered. It's discounted to almost meaningless proportions, and it's not modeled in most DCFs, which tend to, in all honesty, look out no more than 5 years in their actual projections. After all, beyond 5 years, if you're discounting it between 8 and 10%, it's not so important to get it perfectly accurate. So they tend to fade to a mean growth rate. So this is a little bit complicated, and I acknowledge that, but every investor is using a DCF, which is systematically misaligned with future generations and the environment. And that's a cold, harsh reality of the capital markets that we've built since the Industrial Revolution. And I want to be very clear that we need to rethink that. We also need to look at how the international financial architecture, which was built mostly after the Second World War at Bretton Woods, and then the Marshall Plan, we need to think of how they're operating this century. And I think it's time to repurpose some of the organizations and ensure that their mission of, for example, the World Bank, the IMF, and particularly the OECD, is fit for the climate crisis. The OECD is a $400 million institution per annum, employing some of the world's best economists and people who also understand the climate crisis. And it was originally built for the Marshall Plan and marshalling economic restructuring in Europe. This century, I believe its current role should be to take that experience and ensure that it's doing everything it can to mobilize the roughly $1 trillion a year that we need to rebuild global markets and invest that trillion. It's not a gift, it's not a donation, it's an investment. To invest that in powering the change within the real economy, which will then drive the climate crisis away. We need to use the 400 trillion in the global capital markets now in an intelligent way, and we need to harness it to deliver net zero on or before 2050 and a smooth and well-managed transition to that end, which is why I'm so pleased that Layalee is here to talk about the Glasgow Financial Alliance for Net Zero, which is a group of organizations, including ours, coming together to see what we can do to mobilize markets. Be under no misapprehension, this is the biggest challenge of our generation. And as Aviva, we have committed to be net zero by 2040. And that is the biggest challenge we've ever set ourselves in the 325 years of our existence. Paul, back to you.
Well, that was very, very thoughtful. I mean, very, very thoughtful. I really appreciate your comments and where you're going with that. And now this next one, this is something that I think is really unprecedented in terms of size that our next speaker is going to talk about. And she's going to be introducing the Glasgow Financial Alliance for Net Zero that was put together and announced, I think, on Earth Day. So it's, and the person who's going to talk about that is Layalee Ramahi, and Ramahi is a North American coordinator for United Nations Environment Program Financial Initiative. She has an MBA with a concentration in banking and finance and completed a program in sustainable business practices. She's here to talk about the this Glasgow Financial Alliance for Net Zero that we just mentioned, which unites 160 firms together with responsible assets around $70 trillion, leading net zero's initiatives across the financial system to accelerate transition to net zero by 2050 at the latest, is what they're trying to do. And if you look at the comprehensive, I don't think that there's a bigger initiative out there yet than what they're talking about now. So Layalee, we're interested to hear what you have to say.
Thank you, Paul, for the introduction, and thank you for the invitation. And great to be a part of this discussion, and of course, to follow up on the great introduction that was provided by Steve. Just a way of introduction to start very quickly and introduce the Glasgow Alliance, just to give you a way of a feedback where we started in terms of how can we drive financial markets forward? How can we get, as Steve mentioned, a financial market that is fit for purpose, that works not against the global objective of Paris or even the SDGs as global societal objectives, but works with societies to achieve the goals that we want. I work with the UN Environment Programme Finance Initiative. For those of you who do not know the work that we do at UNEP, we are a partnership between the UN Environment Programme and the global financial sector. And the aim is to mobilize the private sector finance for sustainable development. Our focus and aim is to inspire and inform and enable financial institutions to move in towards aligning their work to improve people's quality of life without, as we mentioned, discounting future generations or compromising the future in terms of sustainable development. What we do in terms of supporting the financial industry, and where it started as a discussion, and when UNEP came about in '92 as a global industry focus in terms of aligning to sustainable development, our work with financial institutions is focused and supported by catalyzing the integration of sustainability into the financial markets by focusing on building frameworks and building industry-based principles that will guide financial institutions to align their work with sustainable development. And for our discussion, we're going to focus on the Paris Accord and the Paris Agreement and the goals, objectives of limiting global warming and temperature rise to below 2 degrees and well below at 1.5 above industrial levels. So the frameworks that UNEP focuses on and has built that momentum to see the leadership from across industries. We work with, it started with the Principles for Responsible Investment, which were launched with the UN Global Compact back in 2006, and that guides investors into integration, the broader environmental and social governance issues into their operations. And of that, of course, now the focus on climate change. Then there was the Principles for Sustainable Insurance, which embeds sustainability into the insurance work. And last but not least, the Principles for Responsible Banking that was just launched in 2019, which is the last piece of the major industries that will have the framework to align their work with sustainable development. Now, if we broadly start to frame how major the GFANZ is and where we are at a financial, broader financial sectors level, just to frame quickly how we look at financial addressing climate change in terms of the financial sector, just broadly looking at it from a climate risk perspective in terms of the materiality and the impact of climate once taken into consideration. And we looked at in terms of the data, the metrics, the assessments and the scenarios, and basically the work that the Financial Stability Board's recommendations on disclosure and the Task Force for Climate-Related Financial Disclosures, as known the TCFD, the work that would set in terms of and ask financial institutions to assess the impact of climate change and look at future scenarios and how that will affect their their operations, and that operates across, of course, all industries. And then if we look at the second section, and this is where we lead it towards the climate action, we talk about climate alignment. So what is the financial sector's role in terms of aligning to the Paris Agreement? How does that look like, and what does that mean for financial institutions? Where do they go with it? And what does it mean to be, as a financial institution, as a bank, as an insurer, as an investor? What does it mean to be aligned to a net zero or to the Paris Agreement? And how do we get our portfolios and our investments to be aligned with that longer term objective and net zero by 2050? So one day before the Leaders Summit, the Biden's Leaders Summit in the US on April 21st, the Glasgow Financial Alliance for Net Zero, and you'll hear it referenced to as GFANZ. This is now the term that is globally known as for short, is an alliance that was co-convened and co-launched by Mark Carney, the UK Prime Minister's finance advisor for COP26, and the UN Special Envoy for Climate Action and Finance. It was launched in partnership with the UNFCCC, Climate Action Champions, Nigel Toppings and Gonzalo Munoz, and the UN Race to Zero campaigns and the COP26 presidency. So why the net zero? Why the GFANZ? What is it exactly? In a nutshell, it's an alliance of alliances. The COP26 presidencies, one of their core focuses is to raise ambition, is to get countries not just to raise their NDCs, their commitments to decarbonize and reach the Paris Agreement, but also to ramp up and raise the ambition from the financial sector, and how private finance can play a major role in terms of aligning us and helping governments and all of us then collectively reach the goals that are identified in the Paris Agreement and the goals that we want to reach to limit warming below 1.5 degrees. Now the GFANZ, their focus is on mobilizing these trillions of necessary dollars towards helping the financial system and accordingly help the real economy reach its objective of net zero to deliver on the Paris Agreement. The GFANZ will form that strategic alliance, and it will help financial institutions accelerate that transition towards what we expect in terms of the future and how it will look like. That will mean that all of the initiatives are expected, and financial institutions are working towards reaching that net zero and bringing together under one umbrella a broader alliance that will initiate that discussion among these institutions, 160 financial institutions so far, with $70 trillion of assets across the board that are going to converse, and they are going to broaden the work and coordinate and reach out to stakeholders from governments, from regulators, in terms of aligning their work with the net zero trajectory that we have. So what is included in terms of when we say the race to zero, and what is being race to zero accredited, and that is one of the campaigns that is net zero by 2050 and a race to zero, the campaigns under the COP presidency, and that includes broader initiatives that are provided by the financial sector, including the Net Zero Asset Owners Alliance, which I'm happy that we have, of course, Aviva with us here in terms of reaching as an asset owners, the initial one that was launched, and then what was launched now after that we have the Net Zero Asset Managers initiative, and what we launched with the banking industry is the Net Zero Banking Alliance, and a commitment, a soft launch of a net zero insurance alliance, and that will focus on the underwriting side, and hopefully will be launched by COP26. So this is all to support the ambition, get interim targets set by these financial institutions, work on science-based trajectories that will get us to net zero by 2050 or even before, and transparency from these financial institutions so that we make sure that the funds, the money, the longer term investments, our pensions or our savings are aligned with the targets that serve and work for the Paris Agreement. I will finish and wrap up here, and will hand it back to you, Paul.
Thank you. And I'm just, my video needs to get turned on. So So thank you very much for that. That was very helpful. And we've got a few questions that have come in from the from our audience, and I'm wondering. This first question is for Steve. What can Canada do to promote at the G20 to help secure finance to support the Paris Agreement and help with the climate crisis? What
Brilliant question.
Who can help make that thing happen?
That's fantastic. Thank you, Paul. So two things. Canada is, of course, a very prominent member of both the G20 and the OECD. They relate to each other but are distinct. As a member state of the OECD, the Director General, Canada's Director General of the OECD should encourage Matthias Cormann, who's coming in as the Secretary General, to build on Angel Gurria's leadership. And Angel is outgoing over the summer. Angel has led an international conversation on the economic consequences of climate change for well over a decade. So Matthias has some big shoulders to stand upon and can therefore hopefully see further. So Canada needs to encourage, I think, a root and branch reform of the OECD to be fit for the purpose of managing the climate crisis and reaching out to developing countries so they can harness private finance in the delivery of their own nationally determined contributions. So the OECD could become that bridge that helps where the great need for finance is in developing countries. It helps them understand how to mobilize the money that, for example, Layalee was referred to already from GFANS. So there's the OECD piece. And at the G20 can mandate organizations like the OECD to do that. And just as the G20 mandated the Financial Stability Board to look into the task force for climate-related disclosure and look at the disclosure consequences of this area, I would love to see Canada support a strong G20 communique from Rome and Venice in July. So there's the finance ministers meeting in the middle of July, and then in October, the heads of state in Rome. And the communiques there could invite the OECD to step up and take on this new challenge now that they have dealt unequivocally with the restructuring of Europe and delivered the Marshall Plan and created greater economic integration. In fact, they did that more than 50 years ago. So the new challenge, as I say, is upon us, and Canada can harness the OECD and its G20 membership, hopefully alongside the UK, of course, where I'm from, and the other 36 member states of the OECD and 19 of the G20. I hope that answers your question, Paul.
It sounds really good. I'm very intrigued by that because it essentially, from what I can see, you want to have the OECD become really a key pillar in terms of changing the financial system so it supports the Paris Accord and rather undermines it. Because the way you spoke about earlier, how the way the current thing works is that it's essentially a market failure with how we're discounting the impacts for future generations, and this needs to be changed. So we really need to transition our financial system so it supports the Paris Accord rather than undermines it. So that's quite good. And now I've got a question here for Layalee here. So the Canadian banks are currently amongst the largest investors in fossil fuels. What would you say to CEOs of these banks as to what they should be doing, and compared to these new alliances that are coming together?
Well, thank you, Paul. That's a great question, and indeed, the Canadian banks come from an economic reality that Canada is a resource economy, and of course, we've seen progress from the financial sector from the Canadian banks. We've seen net zero commitments across the board from a number of the larger financial institutions, and as well asset owners, and not just only banks, and also asset managers. So we've seen the development and the focus and the drive from the financial market. But I think what I would say to Canadian financial institutions, or even other financial institutions, in reference here to Steve's point when he said we committed to net zero by 2040. It's not an easy task, And it's not that somebody has all the answers, but we have to start doing the work. We cannot wait until the solutions are there. We cannot wait and count on innovation or on carbon capture and storage, or on other transition pathways to be bulletproof, to be approved, and to be tested. We have to make the commitment and figure out as we go, because we do not have time to wait for that to be clear. And I think the TCFD is a major part of that. And Canada has done a lot in terms of mandating TCFD and now on crown entities. And even as part of the COVID relief packages in terms of requiring companies to disclose their climate risk and exposure. So when we start to talk about it in terms of we understand the reality, but we need to transition, this is where we go forward with that, and we ask financial institutions to take the leap forward and be open with it.
Okay, well, that's very useful. That so many things are happening simultaneously. One thing that does come to mind is from a conversation with a person from the oil and gas sector in last session, that they're looking for transitioning. So many CEOs are now looking at how they can transition to a low carbon future that are in the oil and gas. And why is this happening? And that's because I think of the TCFD and other initiatives where the banks are telling them that soon they're not going to be getting any more money, that they have to change, or the money won't be there. And so I think that's having a big impact. Now I've got another question, is that in recent years, I think this is, both guys can think about this question, is in recent years there's been expansion of green investment funds. However, instead of investing in new green technologies, many of these funds just simply stay away from fossil fuels. So they talk about being green, but it's a little bit more greenwashing, right? There's a little bit too much greenwashing going on. So what can be done actually to get it so that if you're, that you're really, if you say you're a green fund, that you're really doing green investing, and that you're not just simply greenwashing and making a bunch of money for your own personal bank account?
Layalee, would you like to go first, or do you mind if I kick off?
You can kick us off, absolutely, go ahead.
So whoever asked that question, I'd like them in the audience every time I speak from now on. That is a really good question. And I think if I can use a metaphor, if you're trying to tidy up your garden and you throw your rubbish over the fence, that's not dealing with the problem. It's someone else's problem. It's the same with the portfolio. If I just chuck all of the rubbish out of the portfolio, if I sell companies that are controversial in other people's mindsets, then that's not helping support a transition. That's not powering change. That might give someone a clear conscience somewhere, but it's not actually helping the world. So I think there are other strategies that need to also be deployed for a fund to be credible. One of them is integration. So looking at a market inefficiency that exists in this area and exploiting it to make sure risk-adjusted returns are maximal. That's what every institutional investor pretty much now claims to do. Then you've got micro engagement, engaging with companies to promote change and improve practices, and that includes votes. For example, 87% of the investors today supported a resolution at Shell around a transition plan, which Shell had tabled. We've been backing that, and at BP too, which comes to your point earlier, Paul, about how these companies need to transition. And then it's also about deploying capital into companies that are solutions, as the questioner proposed. But there's also another strategy which I think needs to be deployed at scale and fast. And that's macro stewardship, engaging with those that set the rules of the game to ensure that the rules are aligned with net zero. That means harnessing the profit motive through tax and subsidy, through market mechanisms like emissions trading schemes, through regulations, standards, and consumer awareness. Now that's a full package. And it's only when we have a full package that the market will be harnessed to deliver the Paris Agreement, rather than at the moment where it's destroying it.
That I fully agree. Do you have any quick thoughts on that? We only got 1 minute left there, Layalee.
Yes, I think Steve said it very perfectly. And I think for us collectively to avoid greenwashing, that's why GFANZ has focused on the alliances and bringing together rules and regulations to set interim targets, science-based targets and trajectories over where and how you're going, and you're going to disclose and track that. So if I'm a financial institution and I'm offering you green funds and I'm not a signatory to anything, I think you need to be a bit fishy about it and think twice before you invest your money there.
Okay, that's very good. So well, thank you. I would say, out of all the sessions, I mean, this financial session for me is the most encouraging, because there's so much money going on, available to make this transition happen. And I think it is causing, the way things are going, it's causing the oil and gas executives to rethink about how they're doing it, all kinds of people in the sector. And we could, it's almost like something we spoke about before, where that the markets can drive behavior, right? So if the markets are incentivized to support fossil fuel, that's what you're going to get. So you've got to go and change the incentives so that it supports the Paris Accord rather than undermines it. So thank you very much both for your time, and let's see what can be done to make it happen in a big way.